This is Rob Bruner at Valtinson Bruner Financial Planning, and this is a webinar in our series called Confident Financial Future. And today we're going to talk about Social Security planning and what baby boomers need to know to maximize retirement income. This is a subject of interest to almost everybody because almost everybody qualifies to have a Social Security payment during their retirement. From a disclaimer standpoint, just wanted to let you know this video does not constitute advice to you. We don't know your personal situation unless you're a client of ours. So please take this as education and not specific advice for your situation. So what we're going to talk about today and what baby boomers want to know. They want to know, will Social Security be there for me? So we're going to talk about the funding of the system and whether or not it will be there for you. They also want to know, how much are they going to get? So how much are you going to get? You've worked your whole career. What's your Social Security payment going to look like? Then the big question, when should I apply? When should I start those payments? And how do I maximize the benefits? How do I maximize my Social Security in relation to my other assets and other income sources that I have? And will Social Security be enough for me to live off of? Now we want to talk about understanding the value of Social Security. Social Security is really a valuable asset in your financial picture. Will it be there for me? So will it be there? The Social Security Trust Fund is still growing. At the end of 2018, it was about $2.89 trillion. And then in 2019, it brought in $1.062 trillion and paid out $1.059 trillion. So it had a net increase in assets of about $3 billion into the Social Security Trust Fund. So it ended 2019 with a $2.897 trillion balance. Now, the long-term projections without any reforms to the Social Security system is that the benefits could fall to about 80% of their scheduled benefits in 2035. So that's kind of the estimate of where we're at now. What would it take to restore solvency to the system? So if we made some adjustments, what would they have to be and how would they have to work? Well, one thing we could do is we could increase the maximum earnings subject to Social Security. Currently in 2020, the maximum earnings subject to the Social Security tax is $137,700. So they could raise that number. We could also raise the normal retirement age. As many of you know, the normal retirement age was 65, and then it has slowly been risen to 66 and 67, depending the year you were born. Could also lower benefits for future retirees or kind of adjust how they do the cost of living adjustments to Social Security. The bottom line for baby boomers is your benefits are really not likely to be affected by Social Security reform in any major way. Usually what they do when they make changes is those that are close to getting benefits, they grandfather those people in, and then they make adjustments for the younger generation. So what's a clear way to think about Social Security? Insight number one is Social Security is inflation-protected income. You've paid the premium in with every paycheck you've paid, so be smart about how and when you collect that benefit. Social Security offers income you can't outlive. So it's going to, if you're eligible for Social Security, it's going to pay for your entire lifetime. And let's just say your monthly benefit today is $2,000 and you live 10 years. Well, you will have received $270,000 from Social Security. 20 years, you will have received $619,000, and 30 years, over $1 million. This is assuming a 2.6% cost of living adjustment, and that's kind of been the average over time. It also offers those inflation adjustments I talked about. So the number you start with Social Security is not the number you end up with year after year. So you could start at $2,000 in 10 years. If you get those cost of living adjustments averaging 2.6% a year for 10 years, your payment's going to go from $2,000 to $2,585 over 10 years. After 30 years, it's $4,300. So it offers those built-in cost of living adjustments. The big question, how much am I going to get? So what is Social Security going to pay me? Your benefit really depends on two things: how much you earned over your working career and the age at which you apply for benefits. And we're going to get into a little bit of the mechanics and the behind the scenes on how Social Security is calculated. You don't necessarily need to know this, but I think it's good background information to have. So at age 62, they tally up your earnings and they index that for inflation. The highest 35 years of earnings are average. That's called your AIME. And then that number is divided by 3, what they call bend points, to determine your primary insurance account. And you'll hear me reference PIA throughout this conversation. That is your primary insurance account. And that's the amount you would receive at your full retirement age. And then the benefit is increased each year by the cost of living adjustments that are announced each year. So here's an example. Baby boomer born in 58, maximum Social Security earnings every year since 22. It's a little bit unrealistic that you would earn the maximum every year. So their aim is $10,683. So the PIA formula, as you'll see, they apply on the first $960, it's 90%. On the next $4,825, it's 32%. And on the next $4,898, it's 15%. They add those up, and that gives them $3,142. So that is this particular person's PIA, their primary insurance account. And again, that's the amount you would receive at your full retirement age if this was you. So that's good to know. But why shouldn't I claim it at 62 instead of delaying and get my full benefit at 70? Well, your monthly benefit will be reduced if you claim early. I think everybody kind of knows that. You may also be reduced for taxes and Medicare premiums. So your net payment you get in your bank account is going to have potentially some taxes taken out of it and Medicare premiums taken out of it. And benefits could be withheld if you work. So if you retire before your full retirement age, they could pull back some of the money that they're getting if you take Social Security before your full retirement age and you continue to work. So we're going to talk through that. So what is full retirement age? So if you find your year of birth on this list and go across, if you're born in 55, your full retirement age is 66 and 2 months. At 1960 and later, it's 67. So this is your full retirement age. Remember what I said, your PIA, your primary insurance account number that is calculated, that's what you get at this full retirement age. So what if you apply early for benefits? What's your reduction? So here you'll see if your full retirement age is 66 and you apply at 62, you only get 75% of your PIA. And again, if your full retirement age is 67, and again, this depends on the year you're born, you apply at 62, you get 70% of your benefit. And so each year you wait, you get a little bit more until you hit your full retirement age when you get 100% of that PIA. So what if you apply after your full retirement age? So let's say your full retirement age is 66. Well, at 66, you'd get 100% of your PIA. At 67, you'd get 108%. So it jumps up quite a bit. And all the way down to age 70, you'd get 132% of your primary insurance account. So they do give you lots of credit for waiting. So how do you estimate your Social Security benefits? I encourage everyone to set up an account at socialsecurity.gov, and you can download your statement there. Many of you have seen this statement. It's a 4-page statement. It's got green on the front. On the inside page, it shows your estimates usually at age 62, your full retirement age, and 70. Page 3 shows your earnings history, and page 4 is kind of just a back page. So you can set up your account there and look at your statement. Now, the other thing to do is there are some calculators at mysocialsecurity.gov, and you can click on estimate your benefits. And then you can put in when you plan to retire, what you assume your income to be. That'll give you a little bit more accurate estimate of your benefit than what your statement shows. We can also run estimates for you. We have some different software that if you give us your earnings history and your PIA number, we can run some different scenarios to see what would be the optimal claiming strategy for you. So let's talk about spousal benefits and how these are going to work. So we already talked about your PIA calculation and how that would work for you. From a spousal benefit standpoint, the spousal benefit is half of the primary worker's PIA if started at full retirement age. Now, by primary worker, we're basically referring to the person of the couple that made the most over their career. That would be referred to as the primary worker. So it could be the husband, could be the wife, just depending on their situation and earnings. And the spousal benefit is half the primary worker's PIA if started at full retirement age. So quick example, John's PIA is $2,000. Jane's is $800. If Jane applies at her full retirement age, her benefit will be $1,000, not her $800. It'll be $1,000. That's 50% of John's PIA, his primary insurance account. So the rules for spousal benefit: primary worker must have filed for benefits. So in that case, John must have filed. The spouse must be at least 62 to get a reduced benefit, or 66 for the full benefit. And there are no delayed credits on spousal benefits after age 66. So we saw on our own benefit, if we wait beyond age 66, we do get some credit for waiting on a spousal benefit that doesn't apply past full retirement age. Divorce spouse benefits are basically the same as spousal benefits if you meet some criteria. Their marriage must have lasted 10 years or more. The person receiving divorce spouse benefit is currently unmarried. So if you get remarried, then your new spousal benefit is based off your new spouse, not your ex-spouse. And the ex-spouse has to be at least age 62, and the divorce has to be more than 2 years ago. Then the ex-spouse does not have to have filed for benefits. So divorce spouse benefits work pretty similar to spousal benefits. They're meant to protect the person in a divorce. So pretty close to the same as spousal benefits if you meet these criteria. The rules for divorce spouse benefits is more than one ex-spouse can receive benefits on the same worker's record. So I kind of tell the joke of, well, if I got married at 20 and divorced at 30 and married right away and divorced at 40 and married right away, and I could have 4 ex-wives claiming divorce spouse benefits on my Social Security record if they didn't get remarried. The benefits to one of those ex-spouses does not affect those paid to the worker, to the current spouse, or other ex-spouses. So it doesn't matter that 2 ex-spouses are getting a Social Security benefit based on my benefit. And the divorce spouse benefits stop upon remarriage. So like I said, if you get remarried, your new spousal benefits are going to be based off your now current spouse, not your ex-spouse. So survivor benefits. Social Security is not only a retirement program, but it is a protection and income protection for survivors. And so we're gonna talk about how that works. Now, we're gonna get into some of the nuances here. So, but it is important to know how Social Security can protect a survivor and how your claiming decision can affect your survivor benefits. So the survivor benefit depends on the age at which the deceased spouse originally claimed the benefits. So if you claim before your full retirement age, the survivor benefits are going to be limited to 85 or 82.5% of the PIA. So they're going to be reduced. If claimed after full retirement age, the survivor benefit will include those delayed credits. So if I delay taking Social Security, that does affect what my spouse would get if I die before she does. And then the other factor is the age at which the widow claims the survivor benefit. So if my widow claims before her full retirement age, she's going to get a fraction of what she would have normally gotten. If she claims at her full retirement age or later, her survivor benefit will equal 100% of my originally claimed benefit. So we're going to look at how that works in practice here. If spouse dies while both are receiving benefits, the widower switches to the higher benefits. So just a quick example of that. Joe and Julie are married. Both are over full retirement age. Joe's benefit is $2,000. Julie's benefit's $1,200. Joe dies. Julie basically is going to notify Social Security, and her $1,200 benefit is going to be replaced by her $2,000 survivor benefit. So you're going to jump up to the higher of the 2 benefits that you've been receiving. So here's an example of claiming early and how that can affect a survivor benefit. So we got Joe and Julie again. Joe's PIA is $2,000. He files at 62. So remember, he got a reduction. He only gets 75% of that $2,000. So he gets $1,500. Joe dies. So now Julie's survivor benefit will depend on when she claims it. If she claims her survivor benefit at 66 or later, her benefit will be 82.5% of Joe's PIA, that $2,000, or $1,650, which is a special floor for survivor benefits. If she claims her survivor benefits at age 60, her benefit will be 71.5% of that $2,000 or $1,430. So the survivor benefit is really one of the only ones you can get before age 62. So we see here the example, at age 60 is when you can claim a survivor benefit. That's the earliest. An example of a delayed claiming, and this is going to show how Joe's delay can affect the survivor benefit. So again, they're married, but Joe waited till 70. So he got 132% of that $2,000 PIA. He gets $2,640. He dies. Julie's survivor benefit will be equal to Joe's benefit of $2,640. If Julie claims her survivor benefit at 60, the earliest she can, her benefit will be 71.5% of that $2,640 or $1,887. If she claims at age 66 or later, her full retirement age, her benefit will be 100% of that $2,640. So she reaps the benefit of the fact that Joe waited to claim his benefit. So some of the rules, you got to be married at least 9 months, except if the death was caused by an accident. The survivor must be at least 60 for that reduced benefit. So again, the earliest a survivor can claim is age 60 or full retirement age for the full benefit. The survivor benefit is not available if the widow or widower remarries before age 60, unless that marriage ends. So as an example, I had a client I was meeting with, and he had unfortunately lost his spouse and was looking at getting possibly remarried a couple years after his spouse had passed away. He was 59. And so we talked about the fact that he was going to claim his survivor benefit at 60, but if he got married before age 60, he wouldn't be eligible for that. So they weren't planning on getting married till they were 60 anyways, till the next summer. So it all worked out. He was able to get married when he was 60 and still be able to claim that survivor benefit on his deceased spouse. So when should I apply? Big question. Here's the factors to consider. And I will say that the decision to file for Social Security is made with the best available information that you have now. It's not a perfect decision. There's no exact mathematical formula to make this decision, but these are some of the factors you have to look at when making this big decision. One is your health status. If you are healthy and have long life expectancy, it pushes you towards a decision of delaying because you're getting those credits for waiting and you're going to get those bigger payments for a longer period of time. Another thing is need for income. So if you have minimal other assets, you might need Social Security to provide that income. If you have other assets and you can get your income from those other assets, it might enable you to delay that Social Security payment. Whether or not you plan to work, we're going to talk a little bit about how that works. Is if you still plan to work and you're below your full retirement age, it may not make sense to take Social Security because you're going to have some of it pulled back if you make over the limits we're going to discuss. And then survivor needs. We've already talked about the survivor needs and how your survivor can be affected by the decision that you make in your claiming decision. So why delay? Well, bigger checks to start with. We look here, if we claim at 62, you get 70% of what you would have gotten at your age 67 PIA. So your benefit with COLAs is $1,960. If you claim later, you get much more. So it's just bigger checks to start with if you delay. More income later on. So if we get those cost of living adjustments, if you claimed at 62, your check at age 80 might be $3,100. If you waited till 67, it might be $4,600 under this example. If you waited to claim at age 70, $5,500. So if you look at the gap between these two numbers, that's basically $2,400 a month, that difference in claiming strategy. So key points to remember: if you apply early, your benefit starts lower and stays lower for life. So you don't get really much of a do-over here. The cost of living adjustment, they call them the COLAs. Cost of living adjustment, every year Social Security calculates and says, we're going to give you a raise. Now, they don't give a raise every year if they assume the cost of living has stayed the same, but the average over time is about 2.6% on average. Some years it's 5%, some years it's 1%, some years it's 3%, but the average is about 2.6. So those cost of living adjustments magnify the impact of earlier delayed claiming. If you start with a bigger number and you're getting a percentage increase on that number, it's going to magnify that decision and say, well, that 2.6% of $3,000 is more dollars than 2.6% of $2,000. So the longer you live, the more beneficial it is to delay benefits. And then your decision impacts survivor benefits as well. Delaying benefits may give the surviving spouse more income. So how do I maximize benefits? There's a few things to look at here. Is improve your earnings record. I mean, number one is the higher the income, the higher the Social Security benefit. One thing to do, though, also is to take a look at your statement. When I mentioned the statement before from the Social Security website, on page 3, it shows your earnings history. And we have run into some situations where clients' earnings history that we've examined is actually inaccurate, and we've had to help them correct it with Social Security. So you want to make sure your earnings statement looks correct. Make sure every year that you worked, they're showing some earnings history in there on that list. And if there's any missing years, you want to get that corrected. It's not very common, but it could come up. And you want to apply for Social Security at the optimal time. You want to consider your income needs both now and in the future, your life expectancy and your spouse's life expectancy. Now, the other thing is if you're going to work. So the annual earnings test looks at Social Security and says, if your earnings are above a certain limit, we're going to pull back some of your Social Security. So this number just went up a little bit in 2019, in 2020. In 2019, it was $17,640. So if you're going to take your Social Security benefit before your full retirement age and still work and make over $18,000, it may not make sense to file for Social Security at that time. Now, it will get readjusted at your full retirement age, so you do get it back, but it gets paid back to you over your whole rest of your life. So it's not a lump sum payment. So to avoid that earnings test, you can wait until your full retirement age or later to apply for benefits. At your full retirement age, it doesn't matter what you earn. They're not going to pull back any of your Social Security. So you can wait till a full retirement age and make as much as you want in another job and not have any of your Social Security pulled back. Coordinating spousal benefits. So we've talked a lot about how spousal benefits can work. Where there's a lower earning spouse, if their PIA is more than 50% of the higher earning spouse's PIA, both spouses can delay to age 70. And then there are some special, provisions that we can have one spouse elect and have another one delay Social Security election. And this maximizes benefits over an average or a longer life expectancy. The hybrid strategy, and this is a strategy that really comes into play for a lot of our clients, where the two extremes of claiming Social Security are both of you claim early as a couple, or both of you wait till 70. Kind of the middle ground in strategies is where we have the lower earning spouse claim their benefit early and the higher earning spouse delay to maximize that higher earning Social Security benefit. In this strategy, we generate some income now while also maximizing the higher earner's benefit over both lifetimes. We also want to minimize taxes on Social Security. So as much as we can, we want to control taxes in retirement. Taxes are a huge component of retirement income planning that we do with our clients. The taxation of Social Security works like this. They calculate what is called your provisional income. On the bottom of the screen here, provisional income is your adjusted gross income plus 1/2 of your Social Security benefit plus tax-exempt interest. Tax-exempt interest is interest from municipal bonds. And they add that up. If you're married filing jointly and that's under $32,000, the amount of Social Security subject to tax is 0. If it's between 32 and 44, then the amount of Social Security subject to tax is up to 50% of Social Security. If that provisional income number is over 44, then 85% of Social Security is taxed. And single has a little bit lower numbers, and married filing separately, basically 85% of Social Security is going to be taxed. They encourage you to file the married joint. So we get the question a lot, is Social Security taxable? And the answer is it depends, but in many people's situation, yes, a portion of your Social Security is going to be subject to income tax in retirement. So how do you minimize taxes on Social Security benefit? You can reduce other income from tax-advantaged investments. You can anticipate your IRA required minimum distributions. So we now know your required minimum distributions have to start at age 72. They just changed that rule from age 70 and a half. Now those required distributions from your IRA start at about 3.7% of your IRA balance. And pulling that money out, adding it to your taxable income could cause your Social Security to be taxable. We could, before you turn age 72, you could convert some traditional IRA money to Roth, or before you start taking Social Security, convert traditional IRA to Roth. You could delay your Social Security. That reduces the number of years the benefits are subject to tax. You could reduce your expenses, so you're not taking as much out of your taxable retirement accounts to live off and bumping your tax bracket up. And you just have to continue to manage taxes throughout retirement. Like I said earlier, taxes are a huge part of retirement income planning and can really make a big difference if done correctly. The other thing to consider is Medicare is going to shrink your check in most cases. If you're receiving Social Security and are 65 or older and enrolled in Medicare, your Part B premium will come out of your Social Security check. In 2020, Part B premium is $144.60 if you are not over certain income levels. So at certain income levels, you're going to pay higher Part B premiums. Not going to get into the details here, but just keep that in mind. So in the scenario where you assume a 2,600 PIA and a full retirement age at 67, now if you claimed at 62 and your benefit was 70%, it was $1,820. Your Part B premium at $144 is going to represent 8% of your Social Security check. If you wait to claim your Social Security benefit, that $144 is going to represent a smaller part of your Social Security check. So just be aware, your Medicare Part B premium is an expense in retirement along with other things, but it's going to reduce your payment from Social Security that lands in your bank account. And we have to coordinate Social Security with our other retirement income plans. What the Social Security personnel on the phone or at the Social Security office can do, they can estimate your benefits, they can tell you the amount you're entitled to now, but they won't run scenarios for you. That's what we're here for, to help you figure that out. How do I look at different strategies for taking Social Security along with my other assets to coordinate things and make sure I'm doing things the most efficient way possible? So will Social Security be enough for me to live on? I think the answer that most of us know to that is probably not. We need other sources of income, whether it's from a corporate pension plan, IRA savings, personal savings. We're going to need other income. That other income can come from part-time work, from the pension, your Social Security, your pre-tax 401ks or IRAs. Now that's taxable income from your savings. We have Roth 401k options now, or Roth IRAs. That's tax-free income coming out in retirement if you follow the Roth rules. And then the brokerage or non-qualified savings account, and that taxation depends on which assets you hold in those types of accounts. Other assets like rentals or money you get from an inheritance is going to be another source of income in retirement. So just a quick kind of look at Gary and Sue. They plan on retiring at 62. Gary's full retirement age amount is $1,800 a month. He's got a pension coming in. He's got an IRA. Sue's got Social Security. She doesn't have a pension, but she has an IRA and a Roth, and she has a non-qualified joint account. So they're going to be making a decision with all these different factors in there. What I'm meaning to look at in this case study is we're basically looking at it saying Social Security is not the only decision you're making. You're making it in context of your other assets. So they could both take Social Security at 62. That would mean they take less withdrawals from their assets at 62, but possibly more over their lifetime. They could both take it at 66. They withdraw from their assets from 62 to 66. Then they take their higher Social Security payment at 66 and don't have to take as much out of their assets at that time. Or we could say Sue's going to claim early at 62 and Gary's going to delay. Or they could both take Social Security at age 70. So they have kind of a mix of different options that they can pick. So there's some conclusions to make from this presentation and things that I want you to take away from it. There are many different factors that complicate this Social Security decision. The other thing is it's mostly an irrevocable decision. They do let you have kind of a do-over in the first 12 months if you elect at 62 and want to pay it back. In 10 or 11 months, they'll let you kind of pay it back and restart. But in most cases, it's basically an irrevocable decision. So you got to make a good decision and an educated decision here. Each person and each couple's situation is unique to consider. So you have to take into account what their survivor needs might be, what the other assets that you have. Everybody's situation is different. There's no blanket rule of thumb or rule I can give you that says, if you fit this, this is exactly what you should do. So it takes into account what other things you have going on. Taxation plays a key role in retirement income planning. As I mentioned earlier, the tax savings that can be had from proper planning are just hugely important. And then finally, the financial planning process involves considering all these factors to your specific situation. And you've got to consider Social Security in the context of the other things you have going on. The pensions, the IRAs, the 401ks, required minimum distributions at 72, your investment portfolios, whether or not you want to continue to work a little bit during retirement, all those things have to be considered. So I wanted to thank you for tuning in and watching. Please call or email with any questions that you may have about your personal situations. This is what we love to do. We love to work on retirement income plans, looking at your assets, looking at your Social Security, your pensions, and figuring out really on an individual basis or a couple's basis, what is the most efficient and the best way to do it for retirement income planning for your situation. Everybody's situation is unique, so we want to look at every asset you have, every pension you have, your particular Social Security earnings record to determine the best for you. So with that, you have our contact information here. We'd love to hear from you. Thank you for tuning in. Thanks and have a great day.